Wall Street is roaring back. After years of uncertainty and fluctuating fortunes, the financial heart of America is showing signs of a robust recovery. The S&P 500, a key indicator of American stock market health, has surged by an impressive 15%. This remarkable rise is a testament to the resilience and adaptability of the market. This climb signals a dramatic shift from the bear market anxieties of recent years. Traders on the floor are reacting with enthusiasm, their optimism palpable as they navigate this new landscape. Investors are riding a wave of optimism, buoyed by a confluence of positive economic factors. From improved corporate earnings to favorable government policies, the elements seem to be aligning perfectly. Record highs are being celebrated, but a hint of caution lingers in the air. While the mood is largely jubilant, seasoned analysts remind us that the market's nature is inherently volatile. Is this bull market built to last, or are we in for another roller coaster ride? The market's history is replete with peaks and valleys, and this current surge prompts both excitement and skepticism. This question is on the minds of seasoned traders and casual investors alike. Everyone is trying to predict the next move, weighing the risks and rewards of their investment strategies. The answer, as always with the market, is complex and multifaceted. Economic indicators, geopolitical events, and technological advancements all play a role in shaping market trends. To understand this bullish turn, we need to delve into the forces driving it. Factors such as consumer confidence, corporate profitability, and global trade dynamics are crucial in this analysis. We must also acknowledge the potential pitfalls that lie ahead. Inflationary pressures, interest rate hikes, and international tensions could all impact the market's trajectory. The stakes are high, and the only certainty is uncertainty itself. As we navigate this complex financial landscape, staying informed and adaptable will be key to making sound investment decisions. Several key factors have converged to create this bullish environment. The financial markets are buzzing with activity, reflecting the optimism that has taken hold. Investors are closely watching economic data, which continues to show positive signs. Strong corporate earnings are painting a picture of a healthy and profitable business landscape. Companies across various sectors are reporting better than expected results, which is boosting investor confidence. This surge in earnings is not just a short-term phenomenon, but indicates a robust underlying economy. The rise of artificial intelligence, or AI, is injecting a dose of excitement and potential for future growth. AI is revolutionizing industries by improving efficiency, reducing costs, and opening new avenues for innovation. Investors are particularly excited about the long-term prospects of AI-driven companies. Meanwhile, cooling inflation and the Federal Reserve's recent monetary policy decisions have provided further fuel for the market's upward trajectory. The Fed's actions to stabilize the economy and keep interest rates low are creating a favorable environment for growth. This has led to increased borrowing and spending, further stimulating the market. Each of these factors, on its own, is significant. Analysts are dissecting the impact of each element, from corporate earnings to technological advancements, and the Fed's policies. The interplay of these factors is creating a complex but optimistic market landscape. Together, they form a powerful cocktail of optimism that is intoxicating investors. The collective impact of these positive developments is driving a wave of enthusiasm and bullish sentiment. Traders are celebrating, and the market is riding high on this wave of good news. However, it's crucial to remember that market sentiment can shift quickly. The market's current optimism can be fragile, and sudden changes can occur without warning. Investors must stay vigilant and be prepared for potential volatility. External shocks, unforeseen events, and even a change in investor psychology can dramatically alter the course of the market. History has shown that markets can be unpredictable, and it's essential to consider the risks alongside the rewards. Staying informed and adaptable is key to navigating these dynamic conditions. Corporate America is booming, and the stock market is taking notice. Companies across various sectors are reporting strong earnings, exceeding analysts' expectations, and demonstrating resilience in the face of economic uncertainty. This earnings euphoria is a major driver of the current bull market. Investors are drawn to companies that are profitable and positioned for future growth. When businesses perform well, their stock prices tend to rise, creating a virtuous cycle of investment and returns. This earnings season has been particularly impressive, bolstering investor confidence and fueling the market's upward momentum. Artificial intelligence is no longer a futuristic fantasy. It's here, and it's transforming industries at an unprecedented pace. The stock market, never one to miss out on a transformative trend, is buzzing with AI-fueled optimism. Companies at the forefront of AI development are attracting significant investment. From software giants to healthcare innovators, businesses are leveraging AI to enhance efficiency, create new products and services, and gain a competitive edge. This technological revolution is injecting a sense of excitement and possibility into the market, driving investment and contributing to the bullish sentiment. Section 5. Taming inflation, the Fed's balancing act. Inflation, the persistent foe of economic stability, has been a major concern for investors and policymakers alike. The Federal Reserve's aggressive interest rate hikes were aimed at curbing inflation, but they also raised fears of a recession. However, recent data suggests that inflation is cooling. This positive development has eased concerns about an imminent recession and provided the Fed with some breathing room. The market has responded favorably, interpreting this as a sign that the worst of the inflationary pressures may be behind us. Section 6. The rate cut gamble, a boost for the market. The Federal Reserve's recent decision to cut interest rates has injected a fresh dose of optimism into the market. Lower interest rates can stimulate economic growth by making it cheaper for businesses to borrow and invest. However, this move is not without risks. Some analysts worry that cutting rates too soon could reignite inflation, leading to a boom and bust cycle. Others argue that it's a necessary step to support economic growth and prevent a recession. Section 7. The Tech Titan Dilemma, Dependence and its Discontents. The tech sector, dominated by a handful of mega-cap companies, has been a major driver of the market's rally. Apple, Microsoft, Amazon, Google, and Meta, formerly known as Facebook, have all reported stellar earnings, pushing their stock prices to new heights. While this concentration of wealth and influence in a few companies is nothing new, it does raise concerns about the market's overall health. What happens if one of these tech titans stumbles? Can the market sustain its upward trajectory without their continued dominance? One striking feature of the current bull market is the relatively low level of volatility. The market has been remarkably stable, with few of the dramatic swings that often characterize bull runs. While this lack of volatility might seem reassuring on the surface, it also masks a potential risk. Some analysts believe that this period of calm could be the lull before the storm, a sign that the market is due for a correction. The current bull market is a welcome respite from the bear market anxieties of recent years. Investors are right to feel optimistic, given the positive economic indicators and the potential for continued growth. However, it's essential to temper this optimism with a healthy dose of caution. The market is a complex and unpredictable beast, influenced by a myriad of factors, both rational and irrational. External shocks, geopolitical events, and even a shift in investor sentiment can quickly change the course of the market. In today's interconnected world, real-time data plays a crucial role in shaping market sentiment. Investors are bombarded with a constant stream of information, from earnings reports and economic indicators to social media trends and news headlines. This data overload can be both a blessing and a curse. On the one hand, it provides investors with unprecedented insights into market trends and company performance. On the other hand, it can also lead to information overload, impulsive decision-making, and heightened market volatility. Wall Street's bullish turn is a testament to the resilience of the American economy. This resurgence is not just a fleeting moment, but a reflection of deeper, underlying strengths. The enduring allure of the stock market is evident. Strong corporate earnings, driven by innovative business strategies and technological advancements, have played a significant role. The AI revolution, which is transforming industries and creating new opportunities, is another key factor. Cooling inflation, which has been a concern for many, is showing signs of stabilization. The Federal Reserve's accommodative monetary policy, aimed at fostering economic growth, has also been a crucial element in this positive sentiment. All these factors combined have contributed to a buoyant market atmosphere. However, it's important to maintain a balanced perspective. The market is inherently cyclical, with periods of growth often followed by periods of contraction. This cyclical nature is a fundamental characteristic of financial markets. Understanding that periods of expansion are typically succeeded by phases of contraction can help investors prepare for the inevitable fluctuations. While the current conditions look favorable, with many indicators pointing towards sustained growth, it's essential to approach the market with a healthy dose of caution. Diversification, which involves spreading investments across various asset classes, and risk management strategies are crucial. A long-term investment horizon, which allows for weathering short-term volatility, is key to navigating the inevitable ups and downs of the market. This approach helps in mitigating risks and capitalizing on growth opportunities over time. By staying informed, being prudent, and maintaining a strategic approach, investors can successfully navigate the complexities of the financial markets and achieve their long-term financial goals.